Wealthy and Wise is your guide to value investing, powered by Team Invest.
Hello and welcome to Wealthy and Wise. Well, twice a year, listed companies open their books, profits, dividends, outlooks, all landing in a matter of weeks. Well, for some investors, it's noise. For others, it is the best opportunity of the year. This week on Wealthy and Wise, we're asking how you actually profit from reporting season. I mean, why do great results sometimes send a share price tumbling, while poor ones, every once in a while, send the share price soaring? And how exactly does a value investor cut through the headlines to find real opportunities? So, of course, we'll add some value, go head-to-head through a Team Invest lens on some results we've already had, and we will answer your question of the week. First, though, let's add some value. So every company goes under the microscope in reporting season, or pretty much, but the numbers are backward-looking. The reactions are sometimes emotional, and the share price on the day frequently has more to do with expectations than results. So let's unpack how a value investor should approach reporting season. Welcome to the program, Kevin Robinson from Team Invest. Kevin, lovely to see you. Let's just start big picture. What is reporting season really telling us? And does it matter to a value investor?
Yeah, thank you, Nadine. It's nice to be here. Yes, reporting season is very important because it's the time that if you're a shareholder, an owner of the company, if you like, your tenants or the management are required to report to you in Australia twice a year, obviously, how they're dealing with the business and how they're managing your business and how they're making your profits grow or otherwise. They're required to tell you all of that.
And so, yeah, go ahead.
Sorry, yeah, go on.
Well, I was going to say, so
I was going
you go.
No, I was going to say you were in your introduction there, you hit the nail on the head, so to speak, in that we're looking for differences as long-term investors and value investors. We're looking where the market may differ from what we think of the company. And particularly if you're looking to buy, you want one of those situations where the company reports really well or business as usual, and because of various expectations, the price drops considerably. That can give you an opportunity to buy a company that you really like or you know really well, you're really interested in. And less often is the converse, where a company that you already own may give a very disappointing result, and yet the price might go up, might give you an opportunity to sell some shares.
So let's just take one step back. Is the headline number, so we often hear revenue, sometimes we hear net profit, sometimes it's reversed, I think, depending on what the company often wants you to focus on. But is the headline number the most important number?
I don't think so. Obviously, profits are the important thing. The world is full of people who look at revenue, and particularly these days in a lot of companies that have never made a profit, they're all keen to tell us what their revenue is, but we like to see good, solid profits and growing profits. Revenue is important, obviously, because you need revenue to make the profits. But we like to see what the profitability of the company is and what its prospects are, how well it's doing. And key to us is, can you trust the management to be both competent and trustworthy? So I suppose going into reporting season, I've got a bit of guidance here. Mm-hmm. The key thing is to be prepared. So find companies that you're interested in, that you understand. That's what we do. Is the company understandable? And then get to know it before it reports. So that you will have an idea of the company before you actually get the report out, so you're not in a rush to try and understand it when it reports. Identify your top risks and moats in your company, so know what they are. We pick the top 2 or 3 to get to know beforehand, so again, you're prepared beforehand, you understand what the report might address. When the report comes out, have a look at whether in the commentary any of those risks or moats, if the moats have been eroded or boosted, and if any of the risks that you consider to be the most significant ones have triggered, have a look at the CEO report, have a look at the chairman's report, and just see what they're saying, how they're saying it. You can get a sense of what they consider to be important by what they're saying. And as you said earlier, sometimes a company, they'll tend to want to guide you towards the things that they want you to know rather than the things that really matter sometimes. And again, that speaks maybe to the trustworthiness of the management. So maybe that might be a red flag for you. Then have a look at how the market reacted to the price. And if you get one of those situations where the price drops and it's a good company that you like, and it in fact, the report is as good as you considered, as you thought it would be, and you're thinking about what do I think this company will report. If it does as well as you thought or better than you thought, and yet the price goes down or moves into an area where you think it would be a reasonable buy, then you may need to act fairly quickly, because it may only be temporary, when it may only be intraday, that drop, until the rest of the market figures it out. So that's basically what you can do. The other thing to be aware of in reporting season in particular is your own cognitive biases, and how these might affect your behavior. So one of the big ones is in situations like that I just described, if the price drops, your temptation is often to think, and it's a very human thing, is to think, have I missed something? Does the crowd, does the market know something I don't know? So the better prepared you are before you go into it, the more likely you are to be confident in your own judgment. But it's always something that we can react to. The other thing is the need to be too precise. And some of us are inclined to want exact precision. This is not going to be exact. You can be in the ballpark, and you can be, to use an Americanism, you can be roughly right. And I think Buffett said it's better to be approximately right than precisely wrong. Because if you spend too much time trying to get exact numbers around everything, you could end up missing your opportunity there that you've seen. The other thing is fear of making a mistake, and that kind of relates a little bit to the other one, the wanting to go along with the crowd. If you are too afraid of making a mistake, then you end up in analysis paralysis, if you like, or if you end up doing nothing because you're afraid that you might be making a mistake. And again, miss your opportunity. You will make mistakes. If you take a long-term view and if you invest for any number of years, you will make mistakes. So they will happen. You can always undo your mistakes. The great thing about investing, particularly if you're not leveraged, is shares, the maximum they can go down is to zero. So you won't end up owing money. And if you've chosen well, it's very unlikely they'll go down to zero. If you make a mistake, you can always sell, and you might take a small loss, but it won't be the end of the world, and you can learn from your mistakes. So don't be afraid of making mistakes. Prepare well, but don't necessarily be afraid of making mistakes. The other bias you can have is a bias to action. And quite often, if you've done your research well and you understand the companies, generally most of the time companies report, it's likely to be a ho-hum, I don't want to do anything, it's pretty much business as usual, the market didn't react, didn't give me a good price, so move on to the next one. One of the mistakes I know I made early in my Team Invest membership, and a lot of our members make the same mistake, is we tend to want to act. We want to act before we understand how to invest, before we understand the process and so forth. And often that gives us early mistakes, causes us to make early mistakes. In this situation, be prepared that certainly most of what you see may well be a do nothing, and then you move on to the next one. Wait until you get a good price in a company that you like and understand. So that's sort of my tips, if you like, for going into it. The big theme there is be prepared, and I know reporting season has already started. but be prepared before you go into when your company is reporting so that you understand it well, you understand the risks, you understand the moats. And when they do report, you can listen with a view of does that match what I think it's going to report? And then have a look at the price and see if it's given you a price at which you think is a good price to usually sell or buy, or maybe even sell if you already own the business.
Well, Kevin, that all sounds like such common sense, doesn't it? But I particularly like your point about stocks never falling below zero if you're not leveraged. So does a team invest heart never flutter when you see those headlines? You know, X company has beat expectations. So you're not going into it with that sort of a mind frame that you want your company to beat expectations. What you're saying is, as a value investor, team investor, you're happy if the company just reports in line as expected.
Yes, that's true. I mean, my heart always flutters when that comes up, but I try to be as rational as possible. And I like it. It's more not so much around the expectations of the market. It's more around my expectations. When I'm going in, I have an idea of what I think the company will report. I love it if they beat my expectations. I think it's great. Or if they report what my expectations are. So yeah, in terms of market expectations, when those two differ, then that's potentially where the opportunities are.
And so, as a value investor, do you resist temptation to get excited about companies where you've seen a pretty big share price reaction to the downside on the day? Like, it doesn't make you start thinking, oh, is that great value? Should I get into it? You've already got your sort of list prepared. Are you not tempted at all by any of the idiosyncratic moves that happen during reporting season?
Yes, I get tempted. I always get tempted. And, we're all human. We all do these things. I try my best to be as rational as possible. I'm not always rational. I think I own some shares in a hot sauce company that would be nowhere near our radar. That was a bit of a buy. I was keen on it, and I was tempted. But for the most part, I try to be as rational as possible, and I do get excited. One of the other biases that I thought about that you just reminded me of, if you like, is one of the things that Buffett says is don't fall in love with your company because it won't fall in love with you. And that's more of a long-term perspective. So you do have to try and be as rational, and we all fall in love with certain companies that we like, and we like the management. But in the end, it's all about investment and all about the performance. And if your company drops out of performance, then it's time maybe to sell and to move on to something that's doing better.
All right. Well, now that we have that behind us, and you gave us such a good starting point checklist, why don't we put it into practice and go head to head with some of the companies that we've already seen this reporting season? All right, stay with us. Head to head is next. Theory is one thing, a checklist is another, but let's put it to work on 3 results already on the table this season and ask the same question. What was the market reacting to? What should a value investor do potentially? Well, let's start with Credit Corp. So it was one of the first companies out of the gate this reporting season. We spoke with the CEO here on AusBiz as well. It posted a record full-year profit of around $105 million with its U.S. debt-buying business surging and a fresh push into the U.K., and yet shares were sold off with the market fixating on a more cautious purchasing outlook. So Kevin, is this the classic reporting season puzzle, a record result met with a falling share price? What's your read?
Well, actually, I'll have to confess here, and for the sake of transparency, I did buy some shares when on that drop. So it is one that I've been following for some time and I've been watching. And that was I bought them for my own personal account. So I bought them for me. So it's an interesting company in that it one of the big risks that we talk about often is move overseas, because Australia has this fairly small economy by world standards, obviously by things like UK and British standards and American standards. So companies that grow, and we always look for growth, can often run into the limits of the Australian economy fairly quickly. And then one of the things they do is move overseas. That's a big risk. Plenty of Australian companies have gone overseas and got into trouble because of it. So Credit Corp did the same thing. They moved into the United States doing their business, which is they buy debt ledgers and then collect them. Now, from our point of view, it's an excellent company. We understand it well. A lot of our members understand it well. It's a company that buys the debt ledgers mainly off of big banks and other providers, other credit providers, and then follows up and works with the people who owe the money to enable them, if you like, is the best way to put it, to pay off and to help them pay off their debts, if you like, rather than being the kind of, ring them up and threaten them, that kind of thing, which has a number of advantages, one of which is the reputation of the original credit providers. They like Credit Corp from that point of view because it does exactly that. It keeps their reputation intact. It also means that Credit Corp in Australia and New Zealand has a big database of consumer behaviour, or the defaulter behaviour, if you like. So it can price its debt ledgers really well, and it has a very disciplined approach to that. When prices get too high, they will stay out. They just simply won't buy if it's too high from their calculations. And they're very good at those calculations. And then when they come to recover it, they get a good understanding of those customers and how they behave and how to help them, if you like. And then that feeds into its next business, which is the lending business. So it's then able to lend to these original customers, these original debt defaulters, if you like, understanding the real risk and having had that relationship with most of them already, better than the rest of the market. So that's kind of a cycle, if you like, what is commonly called a flywheel in some places, where the business kind of reinforces itself all the way along the line. So when we heard that result, and it was having trouble, we've been watching it in the United States because it was having trouble moving into the States. It didn't originally understand how the debt market in the States worked. It has been learning, and it had in 2024, it had some big write-offs, mainly because it was still learning about the United States. So although I didn't have any shares in it, I was watching it because I wanted to see how that worked. And the last couple of years, it looks like it has turned that around. It started to understand, and certainly with this reporting season, one of the key things was that it's starting to grow its United States business really well and profitably. So potentially in the future, that business will be much bigger than the Australian business even. It's still learning some of the wrinkles. One of the other aspects that I saw that interview that you had on AusBiz with the CEO, one of the things that I really liked was when Andrew asked him about the share price. And he said, "You're asking the wrong person." He said, "My job is to grow the revenue and grow the profits," which I thought was excellent, because I think there's too much in the market, too much emphasis on business CEOs and share prices, which they can't control. The market controls the share price. Who knows what markets do? So I thought that was an excellent answer, and certainly that helped in my decision to, on the day, to say, oh yes, I think I'd like some of these shares.
Right. Okay. So good one. Thank you. REA last week, just to get to another company in the interest of time, it reported profit up around 15%, Kevin. Dividend beat, shares surged, but I guess underneath the hood, listing volumes were essentially flat. So the growth came from price rises and yield, not necessarily people selling more homes. And, I guess therein lies the value investor's dilemma. A high quality business by most accounts, but it trades on a very high multiple. Can it keep compounding on pricing power alone if listing volumes stay flat?
That is the million-dollar question, isn't it? And you're quite right. There are two things, though, there in its, and they say this in their announcements. the volumes are part of it, but the other part of it is how long it stays, how long a property stays on their platform. Because obviously, as long as if they're longer on the platform, they stay longer on the platform. They're still, whoever's listing it is still paying money to REA. So that's another aspect, and quite often that particular aspect of it can be counter-cyclical in the sense that, and we're seeing a little bit of that in the market at the moment, that even though volume listings may be down, what they are saying is that the actual time on their platforms might be increasing. So that tends to mitigate some of the listing effects. Yes, and it is high multiples for us. It's high multiples and it's kind of stayed that way. So the current PE we make it is 41.9. Do you want me to share?
Yeah, that would be good if you can share your screen.
Yeah, I forgot about sharing the screen.
So did I.
I got so enthusiastic about my recent purchase on the other one that I forgot to share the screen.
Yeah, well, really good to know, and thank you for being transparent about that as well. So whenever you're ready, you can share your screen and we can take a look at what you see in the numbers on Conscious Investor.
Okay, so if you look down here, the current PE by our PE calculations is, and we take a conservative calculation, we don't look at what analysts project, if you like. We tend to look at the actual numbers. So it is a conservative calculation. And it's nearly 42, which for us is high. So even on the day when they reported, I thought, it's a good company, as you say, excellent company, but its PE is quite high. The growth up here is still quite solid at that, and that's the earnings growth at 11.9% per annum, and the sales growth at 13%. So they're very close, which is quite good. So if they're able to keep that up, and looking into the, what's happening in the property market, we would be keeping an eye on what they're saying about, what's happening in the market and how it's affecting the business. And you may end up getting the next season, or along the way, you may end up getting some PE ratios coming down if the market decides to discount it. If you look down here at the PE ratios, what we've got here is for that particular period. So for that year, you've got a high PE and a low PE, which tells you even though it's 42 now, over the last trailing 12 months, it has got down as low as 31.3. So it depends, I suppose, on how you think of it as a technology company or as a property advertising company, because they are also moving into technology and they're reinforcing their user experience, if you like, with AI and with technology. But I'd say for me, the PEs are still high at those levels. All
right, let's do one more, shall we? And a little bit of a tie between the narratives, because of course we're hearing lots from Nick Scaly about the housing environment, how foot traffic is down, I think in some stores as much as 10%, but net profit grew around 22% to $76 million. It did lift its dividend, narrowed the losses in its UK expansion, all as consumers do tighten their belts. So Kevin, this is cyclical, discretionary retailer. Is it executing well in a tough environment? Like, how does a value investor treat a business like this where the result is strong, but the sector is really at the mercy of the consumer and the the macro forces?
Yep, and that's the question. One of the things we do look at as long-term investors, though, and as value investors, is one of the phenomena we get is if you've got a sector that's in trouble, if you're in the best companies in that sector, or the best company in that sector, they will tend to be able to, the best run company particularly, they will be able to ride out that difficulty better than their competitors generally. And that doesn't mean they won't, suffer some losses, or not necessarily losses, reduce profits and, have hard times. But if they do it better than their competitors, they can actually come out of difficult times better off than they were going into it, because they'll pick up business from their competitors, and often you'll find that their competitors will go out of business. And, the competitors' customers will then have to turn to the better run companies. So you often find that. Now, Nick Scaly in particular, it doesn't meet our strict criteria on the basis of debt to equity. and that's largely because of its leases, because in 2020, the new lease accounting standards came in, which count leases as debt. So you'll find that a lot of retail companies in particular, their lease obligations went up during that time. So that's what happened with the debt. But other than that, it is quite a good, well-run company. What Nick Scaly say too, which is worth bearing in mind, is that where they make their money is from when people move home. So what that means is they tend to make more money from people who are like younger families who move home, from renters who tend to move more frequently, because you don't tend to, for the most part, change your sofa for the sake of changing your sofa, for example. You move into a new property and say, hey, we need something that matches the decor, or we need something that matches the space. So that's always worth bearing in mind when you're understanding the company, is how do they actually make their money. So this is one, I think, for us to watch. The PE's a little bit high, but it is a very well-run company. And if we wanted to take a strict lens, we'd say the debt's too high, but it depends on how risky you think the lease debt is. Mm-hmm. The other thing to watch, and we have been thinking about and watching, is they moved into the UK recently, and they have been putting their brand. They bought another business there, and they've been changing their stores over to the Nick Scaly style and brand, and that now appears to be successful, or is becoming successful. So they may well do well in the UK. So we'd be watching what's happening in the UK for them.
So just to sum it up and tie a bow around it, Kevin, of these three results, so Credit Corp, REA Group, and Nick Scaly, I suppose you'd have to say that the biggest gap between price and value really lies with Credit Corp?
To my mind, yes, that's true. Yeah, that was the one. And you could possibly tell by the way I was talking about it, I was a bit enthusiastic about it. Yeah. Which again, we come back as rational as we like to be. We do end up getting enthusiastic about these things. Yeah,
only human.
You have to enjoy
all.
the process of. You have to enjoy the process of investing, I think, particularly if you're a long-term investor.
All right. Well, let's get to our viewer question, if you don't mind sticking around for just a tick, Kevin.
Sure.
Now to your question of the week, and you too can ask the team a question. Just email us at wealthy@ausbiz.com.au. So this one is coming from, I forget who it was coming from, James. I invest mainly for income. Yeah. During reporting season, what matters more, the profit result, the dividend, or the dividend the company declares? Well, I guess therein lies the rub. Like, can you be a value investor and really care greatly about the dividends as well?
You can. What I would say about that, though, is that profit drives the ability for the business to pay the dividend, of course. So to me, and particularly if you're taking a long-term view of investing, then it's more like the profit, the growth in profit, and the dependable growth in profit is what drives the payment of the dividend in the future. So that's the main thing I would be focusing on as a long-term investor and as a value investor. One of the great things about, if you're using the dividends, which a lot of our members are, one of the great things, of course, about price fluctuations is it can give you a PE multiple that gives you a good dividend yield along the way sometimes. So if you can take advantage of those. We have found in the past, we've done a bit of a study in the past, and we've found that a company that grows its profits strongly and dependably, if you take a long-term view and invest over a number of years, what ends up happening is that even though to begin with, when you first invest, the yield on your dividend may not be strong, over a few years, the profit growth drives the dividend up, and particularly the dividend yield compared to your initial purchase price, then ends up becoming quite strong, or can become quite strong. So that's one way of looking at it. The growth in earnings definitely drives the ability of the company to pay dividends. There are a couple of businesses that we look at, and I'll go back to Credit Corp. If you have a look at Credit Corp, and I'll bring it up. Yeah, so if you have a look at Credit Corp there, when the price went down, it does tend to pay. If you have a look at where are we? The dividend yield. Let me go. I'll go to a different screen. I'll go to the return screen here for Credit Corp. Now, what you'll find out, the payout ratio, that says 0. That's actually a mistake. It is 35.2% per annum. And the dividend yield at the moment for Credit Corp was about 5.7%, and that's recent even now. So from our point of view, that's a company which is growing its earnings well at the moment, certainly for the last couple of years. And even if you draw through that 2024 dip, it has overall been growing strongly, and it's got, at the current price, it's got quite a reasonable yield there at 5.7%. Neither of these are recommendations, by the way. It's not advice to buy. I'm just pointing out that some of the companies we look at in Team Invest can give you quite good yields and have reasonable growth as well. Another one is Data3. Their payout ratio is and has been for a long time over 90% of their profits. Now that ratio is the payout. It's not the dividend yield, obviously. It's the payout ratio of the payout compared to their profits. But because of the nature of their business, they're able to continue to grow and pay out quite a strong one. And their dividend yield at the moment is around 3%. So I would say on any of these companies, get to know the company really well so you understand the business, take a long-term view, and you can end up getting some quite good dividends out of them if they're growing their profits sustainably.
Got it. Look, Kevin Robinson, it has been a pleasure to have you join us today on Wealthy and Wise. Thank you so much for sharing all of your insights.
Thank you, Nadine, and it's been a pleasure being with you.
Thank you. And thank you for watching Wealthy and Wise. We look forward to seeing you next week.
Wealthy and Wise is your guide to value investing, powered by Team Invest.